All right, welcome to this explainer. Today we're taking two absolute titans of the Indian banking sector and putting them head-to-head in a classic earnings breakdown. To really understand the heartbeat of India's financial sector, you've got to look at the giants, the ones driving credit growth and locking down the nation's deposits. So we're taking a structured, completely data-driven look at their Q1 results to see exactly how these heavyweights are navigating our current economic environment.
So that brings us to the burning question. Who actually won the Q1 earnings season? Let's dive right in and see what the latest numbers tell us about the real momentum in the banking sector. Because when you stack up the year-over-year and quarter-over-quarter performance, the data reveals a pretty fascinating story. It's this delicate balancing act of aggressive growth on one hand and some very cautious margin protection on the other.
What we have here is the true tale of the tape between two powerhouses, ICICI Bank and Kotak Mahindra Bank. Both are out there fiercely competing for retail deposits, for those lucrative corporate loan books, and really for total dominance across the broader financial services ecosystem. But as we're going to see, their Q1 earnings showcase some distinct strategies and differing outcomes in how they manage these massive pools of assets. Just to wrap our heads around the sheer scale we're dealing with, ICICI Bank is sitting on a staggering 18,335.86 billion rupees in total deposits as of June 30th. I mean, that is an enormous base of customer trust, and it actually represents a very robust 14% year-over-year growth. Meanwhile, Kotak counters with a formidable 572,820 crore rupees in deposits. Now, because of how these metrics are reported, billions versus crores, it's really important to note that ICICI's deposit base is actually roughly 3 times larger. But Kotak's base still grew by a very solid 12% year-over-year. So both banks are scaling rapidly, but the real question we need to answer is, how efficiently are they turning those deposits into revenue?
Let's get into round one. Top-line performance.
In banking, top-line growth is heavily dictated by net interest income, or NII. That's simply the difference between the interest they earn on loans and the interest they pay out on deposits. Looking at the year-over-year numbers, ICICI clearly takes the lead with a 12.7% surge, climbing to over 243 billion rupees. Kotak, though, still posts a very respectable 9% growth. Basically, ICICI's stronger NII growth suggests they were just highly effective at deploying that massive deposit base into profitable lending over the last year. And this perfectly illustrates their bottom line health. Kotak shows a staggering 26% year-over-year jump in PAT. That's profit after tax, hitting 4,123 crore rupees. But take a look at the near-term trend. Quarter-over-quarter, Kotak's PAT only grew by 2%. It shows their momentum is definitely stabilizing. Over at ICICI, core operating profit is up a really healthy 15.6% year-over-year. So the takeaway? Both are highly profitable, but they are absolutely doing it in a tightening environment.
Moving right along to round two, the liquidity battle.
You see, top-line revenue and bottom-line profit, that's really only half the story. The true battleground in today's high-interest environment is liquidity. Securing deposits is one thing, but getting cheap deposits is literally everything. And that brings us to CASA. Current account and savings account balances. These are the accounts that pay zero or very, very low interest to the customer. So naturally, the higher a bank's CASA ratio, the lower its overall cost of funding. It's absolutely crucial for protecting margins.
Pitting them against each other, Kotak actually edges out ICICI here with a strong 40.3% CASA ratio compared to ICICI's average of 38.1%. Kotak has historically been an absolute powerhouse at maintaining a high CASA ratio, which gives them a massive structural advantage in keeping their cost of funds relatively low.
But here is the fascinating twist. Both banks are currently facing a systemic squeeze. Kotak's ratio actually dropped slightly from 40.9% in Q4 down to 40.3% in Q1. In ICICI, they followed a very similar downward trend. Why? Well, in a high-interest rate environment, savvy customers get smart. They move their money out of those low-yielding savings accounts and lock them up in higher-yielding term deposits.
The internal dynamics of ICICI's deposit book perfectly illustrate this exact shift. While their total deposits grew an impressive 14% year-over-year, their cheap CASA balances actually shrank by 2.6% in a single quarter. At the same time, their expensive term deposits surged by 5.5%. So, ICICI is still attracting plenty of money for sure, but they are having to pay much higher interest rates to get it.
All right, round three, asset quality and the broader ecosystem.
Because look, a massive balance sheet means absolutely nothing if a bank is out there making bad loans. So let's check the risk metrics. Kotak asset quality remains incredibly tight. They boast a pristine net non-performing asset ratio of just 0.27%. On top of that, credit costs sit at just 0.46%, and their slippages ratio, which is the rate at which good loans turn bad, is a highly manageable 1.03%. They are running a very, very clean ship.
Plus, it's not just the core bank. Kotak's subsidiaries are firing on all cylinders. Just look at these year-over-year profit jumps. Auto financing is up 30%, securities up 14%, and incredibly, their alternate asset managers division surged a massive 112%. This kind of diversified ecosystem provides them with excellent insulation beyond just standard loan interest.
Over at ICICI, we see a bit more of a mixed bag in their extended ecosystem. Their UK operations held pretty steady, with $16.9 million in net interest income. However, ICICI General Insurance reported a combined ratio of 107.2%. Now, in the insurance world, a combined ratio over 100% basically means the company is paying out more in claims and operating expenses than it's taking in from premiums. It's a great reminder that even these giant empires face cyclical pressures in different divisions.
Finally, let's bring it to the closing bell.
Okay, we've crunched the numbers, we've analyzed the margins, and we've looked at the cost of funds. Ultimately, this explainer highlights the dual reality. Yes, both banks are demonstrating exceptional year-over-year growth, but the macro environment is absolutely shifting. The intensifying war for retail deposits is causing a real quarter-over-quarter squeeze on those all-important CASA ratios. Banks are having to pay up for term deposits, and that is putting immediate near-term pressure on their net interest margins.
So the numbers are on the table. Both ICICI and Kotak have pristine asset quality and immense scale, but they are both fighting a changing tide when it comes to the cost of funds. So we leave you with this to ponder. Based on Q1's liquidity squeeze, which of these giants will adapt fastest to protect their margins in Q2? Keep a very close eye on those CASA ratios moving forward. They're absolutely going to be the canary in the coal mine for banking profitability. Thanks for joining this explainer, and we'll catch you next time.